Investor's Edge with Gary Kaltbaum. Straight talk about you and your money. Now from the BizTalk studios, here is Gary Kaltbaum.
And welcome once again to Investor's Edge. I'm Adam Sarhan, in for Gary K, who's out today. Today is Friday, May 10th, 2024. We've got a great show for you tonight. I want to thank you very much for being here. Before we dive into the market, as you know, this is a show about you and your money and all the fun points in between. Just as a quick reminder, if you don't get the show in your city, you can go to GaryK.com and listen live or archive. We are live Monday through Friday, 6 to 7 p.m. Eastern. Also at GaryK.com, you can follow Gary on X, or formerly known as Twitter, just by pressing the button. There's a big banner right there. You can go on Twitter and type in, or X and type in @Gary Kaltbaum. And you can subscribe to Gary's Morning Notes sent directly to your inbox for free. You may email Gary, ask about his money management services, or join his premium service, which is convictionleaders.com. And there he shares his thoughts about the market several times a day, does daily or nightly webcasts and weekend webcasts, keeps members really abreast with all the changes in the market. You basically can see the market from Gary's eyes and Gary's point of view. So that's all available at convictionleaders.com. So we've got a few topics to discuss this week. First off, notes directly from Gary that I want to make sure I convey at the top of the show to make sure that the message is sent properly. First off, volume has been extremely low. So good price action, if you look at the major indices, the Dow, the S&P, the NASDAQ, for starters, they're all about 1 or 2%, maybe 3% below all-time highs. Now that is really important because price in my world is primary. Everything else, including volume and everything else, is secondary. Why? Because what shows up on our statements? Price. The difference between our entry price and our exit price. That's it. That's the only factor, the variable. If you want to solve for X, think about, back in pre-algebra days or algebra days, that matters with respect to whether or not we make and or lose money. So by focusing on price as a primary factor, it helps give clarity. And it helps people focus on the highest ROI data points. In other words, there's 10,000 stocks out there. There's news, there's earnings, there's so much going on. Today, consumer confidence fell to a 6-month low. But the reaction to the news, the price is primary, everything else is secondary. So that being said, we do, all things being equal, we do want to see stocks go up on heavy volume and then go down on light volume. That typically is healthy action. Why? Because heavy volume shows us what the big institutions are doing. We're not privy to their buys and sells and dark pools and HFTs and LMNOPs and QRSs and TUPs. It doesn't matter. TUVs, it's all nonsense. What they're doing it just shows up based on volume. If you have a stock that trades an average of 1 million shares a day, and then all of a sudden, and it's trading between, let's just say, 50 and 55 for 6 months, all of a sudden it breaks above 55 on 10 million shares a day. Well, that's the big institutions and they're buying. In my book, it's called Psychological Analysis. The idea there is that fundamental and technical analysis are not enough to beat the market. If they were, everybody would win. The third element, my contribution, is psychological analysis, is know thyself, right? So, and bring out the best version of yourself. So in it, and it was number 1 on Amazon every day for 3 months, and I'm very happy about that. Thank you all that read it and left a nice review. If you want to grab it, by all means, feel free. It's on Amazon. And in it, I talk about there's an infinite number of ways to make money in the market. Your job's to find one that works for you. And I always like to say the market is speaking, and then ask, are you listening? So what I want to do now is spend some time focusing on that point. By the market is speaking, and then ask, are you listening? Because what does it mean? Well, up on volume, down only 2% below an all-time high. The market's above the 50-day moving average, which is in of itself a very good sign. Next week, we have inflation data, the CPI and the PPI, consumer prices and producer prices. That's going to be a primary focus. We also have a lot of retail stocks reporting earnings over the next few weeks. Walmart, Target, Home Depot, so on and so forth. So we still have news coming out, but what's really important is the reaction to the news. So let's talk about this point. Adam, what do you mean the market is speaking? I don't hear anything. Well, we know most communication between humans is nonverbal. Well, people talk all the time. You can communicate verbally like I'm doing right now, or you can communicate in a nonverbal fashion. In this setting, on the radio, on a podcast, or on, verbal, you need to have some kind of verbal communication. But when we're in person, a lot of communication happens in a non-formal setting. So this morning, I'm driving my kids to school, and this lady basically comes out of nowhere and runs across in front of our car. Thankfully, I was driving slow. I was able to stop. Everybody was safe. Nobody was hurt. And I told the lady, I gave her the motion of just go ahead, lady, with my hand, and gave her a thumbs up. She looked, she saw she was apologetic. She didn't mean to. It was an accident, but thankfully the accident didn't happen. And she felt bad, but I gave her a thumbs up. I didn't say a word to her. She didn't say a word to me, but we both understood. I smiled at her and see you later and see you later. And I told my kids, I said, hey, that's nonverbal communication, right? If you want to see somebody who's super happy, elated, on cloud nine, you probably can tell me what they look like, their posture, their face, they're smiling ear to ear, so on and so forth. Now take a picture of someone who's really down or depressed or sad or whatever the case, low energy, whatever the case may be, really tired. You see them hunched over, frowning, so on and so forth. So when you meet somebody, smile. A little tidbit there. But most communication's nonverbal. All right, great. The market. So the market's not literally talking to us by using words, because the market doesn't have a voice in traditional setting, but it's nonverbal communication. It's still communicating, and it's very powerful communication. Subtle, but powerful. And it does it with two primary things. It's price and volume. Price and volume. So let's talk about that for a little bit. The reaction to the news, in my opinion, matters more than the news itself. Why? Because it tells us what the big institutional investors are doing with their money. Not what they're saying on TV or whatever the case may be, it's what they're actually doing. They can't hide. Again, the stock has a million shares a day, all of a sudden has 10 million, breaks above resistance, and bam, it's a big breakout in heavy volume. Like Gary says, it's not Aunt Mary and Uncle Bob doing the buying. It's the big institutions. That's a subtle but important sign that, hey, that something has changed. Instead of going sideways for 6 months between 50 and 55, we now broke above resistance, 55, and we did it on very heavy volume. So we don't have to be privy to their insiders, their buying and their selling and their orders and all that kind of stuff. All we've got to do is just pay attention. Look at the new highs. Look at the breakouts. Look at stocks that are setting up to break out. Look at the stocks that are over the 50-day, so on, near 52-week highs, so on and so forth. So when you have the major indices, like what's happening now, down 2% or thereabouts, 1%, depending on the index, below a 52-week high and above the 50-day moving average, that tells you a lot. Even though we're rallying up on very light volume, price is first, everything else is second. Why? Because price is what shows up on the statement, not volume, not earnings, not the news, not consumer sentiment, not the Fed meeting. It's price of what you own. That's it. So there's one of three scenarios that can happen going forward. First off is the market breaks out and hits new all-time highs, which is a high probability. Second, it goes sideways for an extended period of time. Third, it rolls over and has another leg down. Okay, that's it. Literally, there's only three things that can happen after you buy a stock. It goes up, it goes down, or it goes sideways. That's it. Keep things simple, folks. That's one thing that I can tell you that is a superpower. Not just in the market, but in life. Most people try to overcomplicate things. Einstein said keep things simpler, as simple as possible, but not more than that, right? There's an elegance in simplicity. KISS, the military, keep it simple. You know what the last S stands for. Oh, just simplify whenever possible. It can go up, down, or sideways after you buy it. So have a plan. If I enter here, where am I going to exit if I'm wrong? And how much do I risk if I'm wrong? Those questions are so powerful. Where do I enter? Where do I exit? And how much do I risk if I'm wrong? Really, really important. Why? Because at the end of the day, somebody told me one time, he goes, Adam, we're not buying and selling stocks. We're buying and selling risk. I thought that, I mean, the emoji with the head exploding, that's what happened. I was like, wow, that is profoundly genius. Because you're risking your money with an expectation or some hope that over time you're going to have a reward. You'll make more money than you risk. So putting it all together, the fact that we rallied on light volume, not the best thing, but the fact that we're near all-time highs and we're above the 50-day, that trumps everything else. So for the market, we're going into the weekend. Well, the market's acting well for right now. Well, just be prepared. So up next, we've got a lot more to cover. I'm Adam Sarhan, and this is the one and only Investor's Edge.
Hi, I'm Gary Kaltbaum, host of the nationally syndicated radio show Investor's Edge. We're not just handsome radio people. We manage investors' money for a living, specializing in fee-based discretionary money management. No big commissions, just a fee on the assets that's managed. We also provide a full range of personalized services, including retirement planning, fixed income, and educational needs, all to assist you in achieving your financial goals. Understanding not all individuals have the same needs, we'll carefully evaluate your personal goals to determine a proper investment strategy. If your current approach to investing is not getting you to where you would like to be, call us to make an appointment for a complimentary portfolio review. The number to call is 888-422-5559. That's 888-422-5559. That's 888-422-5559. Investment advisory services offered through Kaltbaum Capital Management.
It's time to switch on the integrator units and get the brain cells working.
You're listening to
Hey, this promises to be fun.
Investor's Edge
The last bastion of quality programming.
with Gary Kaltbaum.
It doesn't get better than this.
And welcome once again to Investor's Edge. In case you're just joining us or missed any part of the show, you can go to GaryK.com, rewind, fast forward, listen 24/7 on any device you want, anytime you want. So we spent the first part of the show talking about the market, paying attention to how the market speaks to us. I like to say the market's talking, and our job is, I ask the question, are you listening? And we do it by studying price, because price is objective. It's not someone's opinion. Oh, the price is below the 50-day? Okay. Price is above the 50, price is near a 52-week high, price is near a 52-week low. All these things are objective. You can quantify it. So let's talk about a few more things. We spoke about next week to be prepared for inflation. That matters because inflation's public enemy number one now for the Fed, and it's been number one for about a year and a half, almost 2 years now. And the Fed's in a delicate situation. The economy is starting to slow down just a tad, and it's still strong. But the Fed wants to cut rates, and it can't because inflation's still strong. Inflation is high. We haven't seen a big drop in inflation. If inflation drops too much, that means the economy is getting weaker. So it's one of those dances where it's in the Fed's backs against the wall. Now, let's talk about AI. AI stocks, artificial intelligence, were one of the primary drivers over the last year or so. You had SMCI, NVIDIA, you had Microsoft, Palantir, SMH, which is the ETF for semiconductors. So many stocks, specifically semiconductors or AI-related stocks, had huge moves over the last year or so. Something changed in this earnings season. I just wrote an article in Forbes about this yesterday, where I said AI stocks had a little turbulence. You can Google it. And in it, I noted the fact that AI stocks, the reaction to their earnings, not the earnings were lousy, but the reaction to earnings this earnings season was lousy. SMCI gapped down after reporting earnings. ARM, gapped down after reporting earnings. Palantir, PLTR, gap down after reporting. These are all very, heavy AI stocks, or they benefited from the AI move. ASML, gap down after reporting earnings, semiconductor stock. So that was a big shift in the dynamic in the market or the character, the behavior. Because last quarter and the quarter before that and the quarter before that, you saw the opposite. You saw most of these stocks rally after reporting earnings. So after a big move up, folks, it's really important to just ask yourself, am I late to the party or am I early? Or is it the right time? Why? Because getting in too late, it's not a good thing. Getting in too early is not a good thing. So that right time is really, really important. Timing in life matters, right? Timing in markets matter. If a comedian goes on stage and just botches the joke because the timing is off, the joke could be really funny, but if he says the punchline too early, he or she kills the joke. So same thing with the market. You can have a great stock, but if you get in and get out with the wrong timing, you can miss a big part of the move. So when you look at the AI as a group or a sector, you want to ask yourself, okay, did something change? If so, what? Is the move over? Or is this just a pullback or a correction along the way? And it reminds me somewhat of the dot-com stocks back in the 90s. When I first got involved in the markets, it was around that time, and I saw just some bonker moves. I mean, the markets were just going bonkers. Forget valuation, you had moves that were just mind-boggling. But then what goes up must come. The bubble popped, and March of 2000 was the top. And then the next 2 years, all the way until October of 2002, you just had the market melt down. The NASDAQ dropped over 80%. The NASDAQ 100, somewhere in that area, 85% or 84%, something like that, from March 2000 until October 2002. And then it took like 15 or 13 years to recover. So from that March high. So what happens, or somewhere thereabouts, 13 years, 14 years, it was a long time to recover. Over a decade, let's put it that way. So I think it was 2013 when it got to new highs, if my memory serves me correctly. But the important thing is what? Is that just because you have a decline doesn't mean that the move is over. It could just be a correction along the way. Is AI done? No. It could be. But AI itself is different than how AI stocks perform. Keep that in mind, because there's a lot of people get confused. And another big point I talk about in the book that I want to share with you too is the market is a forward-looking mechanism. And economic data, earnings data, news is by definition a rear view mirror backward phenomenon. It tells us what already happened in the past. But the market is looking forward, but the news is looking backwards. That causes a lot of confusion on Wall Street. A lot of people don't understand that point, myself included. It took me years before I got that clarity. So when the market's looking forward, it's pricing in the next 3, 6, 9, 12 months or so of potential earnings. Now, it's not always right. Things change. Look, Netflix, Meta, all gapped down after reporting earnings this quarter, just a few weeks ago, and then they rallied right back up. Not 100% recovered the gains, but I think Netflix is above where it was before it reported. Meta's right around that same area. Sometimes they gap down, they go back up. Sometimes they gap up and they go down. But it's important to understand the reaction to the news matters. So maybe AI stocks are just resting right now, which is okay. They've earned the right to rest. Even with them resting, they're still the strongest performing, it's probably one of the strongest performing sectors in the market right now. So let them rest. There's no immediate rush. It doesn't have to go up every single day, right? There's an old adage on Wall Street says that the market takes the stairs up and the elevator down, meaning it goes up, goes sideways for a little bit, goes up again, goes sideways for a little bit, up again, so on and so forth until it's ready. And then when it goes down, it just takes the elevator down. Not always, but it's just a good way of simplifying it for people to understand that the underlying dynamic. It goes up slowly, it goes down faster typically. So why? Because fear is very powerful, very, very powerful. And when people sell, they just sell. They get the panic type state, just get me out. And that overrides logic in most cases. So, a few thoughts here. what sector and or sectors will take AI's place? Is this a temporary pullback and they're going to resume the uptrend, which is what I think is going to happen? Or is this just done for the foreseeable future? Time will tell. But stocks like SMCI, look on a weekly chart. You have a really nice downward trend line forming now over the last several weeks. I cover that this weekend in the FindLeadingStocks.com in my newsletter, my weekend report. It was a top stock. Nice setup. If it rallies, hey, it's back in business and it's got its mojo back. But until then, no thank you. So understanding these things change is really, really important. Up next, the state changes. Up next, we've got a lot more to cover. Some more stocks, some more sectors, and a whole lot more. I'm Adam Sarhan. This is the one and only Investor's Edge.
Listening to
America is talking.
Investor's Edge.
He's got to be pleased with that. The crowd is just on its feet here. He's a Cinderella boy.
With Gary Kaltbaum.
Comes highly recommended. You're going to feel better if you talk to him.
And welcome once again to Investor's Edge. In case you're just joining us or missed any part of the show, you can go to GaryK.com, rewind, fast forward, listen, archive, or on demand anytime you want, 24/7 on any device. So, we spoke about a lot so far, and let's keep going because there's a lot more to cover. When you look at the market, it's people ask me this question all the time. It's, hey Adam, what do I do? Meaning, what do I buy? Or what do I sell? The action is really, really important. But let's back up for a second. So, giving the fish isn't one thing, but teaching you how to fish is really important, because then you don't have to ask that question. You can learn. And also, just because somebody does one thing and it might work for them, Warren Buffett's a great long-term fundamental investor. He doesn't look at charts, he doesn't use technicals, so on and so forth. Great. William O'Neill or Paul Tudor Jones or some of these other traders that are more technical oriented. Jim Simmons just passed away today. He's a self-made multi-billion-dollar hedge fund manager, one of the biggest guys in the world in the hedge fund space, quantitative hedge fund space, and he passed away. Rest in peace. He only looked at the price, didn't even touch the fundamentals. Both guys are billionaires. Just because somebody does something and it works for them doesn't mean it's going to work for me or the next person. And that's why in my book I outline the basics. I give you my trading strategy. It's called AMPed, but also give you framework so you can develop your own. I want to empower people to come up with their own, because that means it works for you. So an example, not from trading here, but I'm to illustrate the point here, is working out. So I went to a trainer recently. The guy was a young kid, muscles coming out of his eyeballs. And he's like, I'm going to have you work out so hard, Adam, you're going to throw up. And I said, thank you very much. No, I'm not going to throw up. See you later. I'm not doing it. Now, a 20-year-old or whatever, someone else, maybe that works for them. Maybe they want to go hit it that hard and throw up a few times and then get over that throwing up a few times, and then they're in business. They get the results they want, they get their mojo, they get whatever, they get in flow, whatever needs to happen. I'm not doing that. It's not my goal, not my desire, not my interest, nothing. No interest in that at all. Now, there's nothing inherently wrong with that trainer and or that trainer's system and or way of doing things. He's got muscles, coming out of his eyeballs. I don't, not literally, but you get it what I'm saying. I don't. So clearly what he's doing physically is giving him more muscles than what I'm doing. But what he's doing doesn't work for me. I'm not going to put myself through that kind of a workout, because my priorities, my goals are not the same as his. I don't want to have muscles coming out of my eyeballs. So that approach doesn't work for me. And there's nothing wrong with that approach. In fact, most things in life don't work. And that's okay for every single person. And it's still okay. The key is to find what works best for you. So instead of using that approach, I find a different approach or a different trainer, or might come up with my own program and say, oh, okay, you know what? I'm happy walking. So every day I walk about 15,000 steps on average so far in the last 12 months. Sometimes I'll go up to 20, 21,000. On the low end, I'll do 12 or 13, somewhere in that range. But I need to walk. Okay, I'm not sweating. I should be doing more sit-ups. Sure, I get it. But I'm moving. It's a step in the right direction. And it breaks up the monotony of just sitting all day. Okay, great. That works for me. Take a few breaks throughout the day. Start early in the morning. Bam. Found something that works for me. Now I want to build on it. I'll do some push-ups, then do some sit-ups, and then slowly figure out an approach where I can get some weights, do some basic weights that works for me. That's the key with investing too, is figure out an approach where you're comfortable. There's system traders. Talk about Jim Simmons. He makes computer programs and, buy here and sell there based on rules and all this kind of fun stuff. He's a mathematician. Okay, great. And there's these trading systems. People systematize trading, but then they can't follow the system that they created. So what good is it? In fact, it's not any good at all. So really understanding, know thyself, master thyself, understanding your strengths and your weaknesses is a superpower, both in investing and in life. I'm very good at big example. Here's a story. I'm very good at big picture thinking. My wife, God bless her, she's very good at details. I'm not good at details. So when it comes time to go, strategic big decisions, we'll talk. Okay, great. We come to a conclusion together. Great. We're going to go north. Okay, great. Or we're going to go south. Okay, great. How we get there, the details of it, honey, it's all you. And I get out of the way. Why? Because I know my lane. In Forbes, my lane is investing. I'm allowed to write about anything to do with investing. Comes about sports, politics, the weather, not my lane. I can't write about it. But investing, wide open. Same thing here is know your lane. Know your strengths. Some people are comfortable taking a lot of risk. Some people are not. Some people like growth stocks, some people like value stocks, some people like charts, some people don't. Figure out what you're comfortable with, what you're good with, and if you have to get out of your comfort zone a little bit, that's good. Grow. That's how you grow. But figure out an approach that works for you. And figure out a way of objectively analyzing and making decisions based on price. And get aligned with the market. People want to be in harmony or aligned. I always, joke with the word harmony. I say harmony. You want to be in harmony with the market. Look at the sectors. Look at the major indices first, and then look at the sectors, and then look for the leading stocks in those sectors. Because that's the market speaking to us in the nonverbal way, right? It's a very subtle way. But if you see a lot of AI stocks acting well, a lot of housing stocks acting well, a lot of gold stocks acting well, great, the market's speaking. Hey, we should focus on gold stocks or housing stocks or whatever the case is. If they're all breaking down, hey, this is an area I don't want to be part of right now. That's okay. And it just changes. It's a constant state. It's an infinite game. People love playing sports or, I just played chess with my kids the other day. It's a finite game. There's a certain number of pieces. There's rules. There's a definitive winner, definitive loser. Infinite games are a different set of rules. The market's an infinite game. It's never going to go anywhere. This guy, Jim Simmons, was a master for decades and made billions of dollars. One of the best track records out there. The guy passed away. The market's still open. Same thing. It's just going to, for everybody. It just never ends. So how do you play a game that has infinite? It's an infinite game. The rules of the game are different. It's a marathon, not a sprint type of a thing. You don't have to risk everything on one trade. In fact, I recommend you don't do that. Well, there's no investment advice being given. Do whatever you want. But everything I say is general informational purpose and educational purposes only, nothing else. But, putting everything on one stock, it doesn't typically, historically, usually not the best idea. Going slow and steady, much better idea for an infinite game. Being on top of the market and staying in harmony with the market when the state changes and it goes from strength to weakness, change accordingly. Someone asks me, "Oh, you bullish or bearish?" Well, whatever the market is. the market's acting strong and acting well, great. If it's breaking down, acting weak, get out of the way. Just that simple. And then it repairs itself, gets up again, great. I'll get back in. I don't want to own things that are going down big. Now, if it's a small correction, small pullback, that's one thing. But if it's getting crushed, see you later. It starts breaking support, breaking moving averages. That's how the market's speaking to us. Just about every great stock in history eventually at some point had to be sold because it broke down. A lot of the stocks that were big darlings of the market 100 years ago are gone. 30 years ago, gone. A lot of those .com stocks that went up so much, the ticker's not even available anymore. Either they went bankrupt, they got bought out. Yahoo, YHOO, used to be one of the strongest stocks in the market. It made Mark Cuban a billionaire. That ticker, it's not even available anymore. So things change. They ebb, they flow. Stay in harmony with the market. That's the big picture thought here. Why? Because that over time, an infinite environment will allow you to do very, very, very well. And that's the key. You don't want to fight the market, make the trend your friend. There's another adage on Wall Street. So, up next, we've got some more to talk about. I'm Adam Sarhan. This is the one and only Investor's Edge.
You're listening to...
What are we waiting for? Well, what are you waiting for?
1, 2, ready, go.
Action!
Investor's Edge with Gary Kaltbaum.
And welcome once again to Investor's Edge. In case you're just joining us or missed any part of the show, you can go to GaryK.com, listen live or archive. We are live Monday through Friday, 6 to 7 p.m. Eastern, or you can listen on any device 24/7, anytime you want. Fast forward, pause, or ask whatever you want. Pause, rewind, fast forward anytime you want. So we spoke about the market. We spoke about sectors. We spoke about how to listen to the market. We covered a lot of ground. How to be in harmony with the market. Let's do a few, questions that come up that I get a lot that I'd like to cover. So a big point of the book in psychological analysis is how to make rational, not emotional decisions with your money. One of the biggest problems that I faced for my entire 20s and 30s was, half my 30s, I was making emotional decisions. Unbeknownst to me, I thought I was making rational ones. But when I objectively looked back and studied the market and studied my behavior, that's what really matters. There was a disconnect. The market was up big, but I would miss it. And I'm like, what is going on? So, as I mentioned earlier, I did some introspection. I did some soul searching kind of a thing, looked at my strengths, looked at my weaknesses and said, what am I good at? I'm good at big picture. Okay, zoom out at them, look at the monthly charts, look at the annual charts, look at weekly charts, look at daily if you want. But stay away from the intraday charts. They just don't work well with Adam. I'm not good at details. I'm not good at the, ins and outs and the minutia, but I'm very good with the big picture. So I adjusted my strategy. Instead of looking at the market all day, every day, I would zoom out. I'd look at it. I did most of my work on the weekends when the markets are closed. And then I'd have a plan for the following week. Now all of a sudden, I'm not making emotional decisions. I'm not chasing something. I'm not FOMOing in, fear of missing out, or I'm not, chasing something that's up too much because it's extended. No. And if I miss something, that's okay. Now all of a sudden, there's a structure. and I'm aligning my investing with my strengths. And at the same time, I'm reducing the unforced errors. Think of tennis or any game that, there's unforced errors where I just hit the ball out for no reason. That's an unforced error. If I'm not interacting in the intraday charts because I'm not good at that, I know I'm not good at that, so stay away from it. So I'm reducing the amount of unforced errors that are going to come, and I'm increasing the probability of success because I'm staying in my lane. I'm fishing in a pond where Adam has a higher probability of success. So the big point of the book is learn how to make rational, not emotional decisions. And then as I reread some of the old classic books, there's a great book by Nicholas Darvis called How I Made $2 Million, or the title of the book was How I Made $2 Million in the Market. And he was a ballroom dancer back in, I think it was the 60s or 70s. And what he did was, this was before the internet, he'd go to Asia and he'd have the broker fax him or telex him or whatever it was back then, the charts and Barron's magazine and blah, blah, blah. And he would send back orders, but he'd have to put orders for entry and orders for exit. And then he would do whatever he was doing, and he did very well. And he made $2 million decades ago, back when $2 million was really, it still is a lot of money, but a tremendous amount of money back then, just trading stocks. And then he went back to New York and he got annihilated because he was in the broker's office and he was buying and selling and just making decisions, and emotions were high and blah, 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 blah. Then he took a little, retreat, whatever word you want to use. He got on a plane, went to Paris, and he started doing well again. Well, what he noticed was when he planned his trades in advance, he would do well. But when he was in the middle of the broker's office and people are yelling and screaming and stocks are going up and down sideways, there's no rhyme or reason. So it didn't work well for him. Now, someone else might do very well staring at the screen all day. It just, for me, that doesn't work well for me. Okay, great. So find out what works well for you, folks. That's the bottom line. And then stick to it. There's going to be temptations, and that inner narrative is super important. Who do you talk to more than any other person in the world? Yourself. Be mindful of that conversation. Bring out the best version of yourself. In the book, I've got two characters. There's cartoon characters. The only investing book that I know of that has cartoons in it. One is a superhero, and the other one is what I call the smart money superhero, and the other one is the dumb money beast. And the dumb money beast, like a Tasmanian devil that runs around and makes emotional decisions and causes chaos and just subpar decisions. And it's in all of us, those two kind of good, evil, the smart, bet, dumb, whatever word, however you want to, that dichotomy is in all of us. Okay, I just make cartoons so people can quickly, easily understand the concepts. So now I ask myself, how do I bring out my superhero? How do I increase the probability of success? Make smarter decisions. And then when I bring out my superhero, who's going to perform better? My superhero or the dumb money beast, who I call Schmelf in the book? And we call it in the house too. When somebody's off, we're like, oh, they're schmelfing. My kids or my wife or whatever. Me, I'm off. My wife's like, okay, you're schmelfing. Okay, great, I get it. And we can step back. There are a bunch of cognitive biases that are in the book too. And one of them is the personal blind spot bias. People can't see themselves objectively. And that's a big problem for traders. Ask how many, I speak to traders all over the world, and how many people, I'm in a room and think they're going to beat the market. Everybody raises their hand. Statistically, we know most people are not going to beat the market. Ask newlyweds. You want to hear? Here's an example. 100 newlyweds get married the night of their wedding. How many people think they get divorced? No one's going to raise their hand. But statistically, we know half of them are getting divorced. People can't see themselves objectively. So part of this whole process is helping you bring out your superhero and overcoming some of these biases. If you have a mind, you have biases. It's just that simple. So learn them, understand them, know what they are. Do things to protect yourself from schmelf, right? Which is the emotional version of, and the lesser intelligent person that's inside of all of us, that we just make silly or questionable decisions. I'm trying to use nice language here. And you understand. It's in all of us. It's universal. You bring out your superhero, you plan ahead, all of a sudden, you now take a step in the right direction of being more and more in control. Not of the market, but of your behavior. That's key. It's controlling the behavior. Because we can't control the market, but you can control how you react to it. Same thing with anything in life. You can't control what happens to you in life, but you can control how you react to it. And that's so liberating. It's so powerful. So as we go into the weekend, take your time, go through the market, look at the leadership, look at stocks that are acting well. We've got inflation coming out next week. We've got earnings still from all the big retailers. Take your time. As long as we stay above the 50, things are give the market the benefit of the doubt. If we break down, be prepared and ready for another leg down. Anyway, that's all the time we have for today. As always, I want to thank you very much for being here. I'm Adam Sarhan. This is the one and only Investor's Edge.
This has been Investor's Edge with Gary Kaltbaum on BizTalk. To listen to past episodes or to get in contact with Gary, go to GaryK.com. That's GaryK.com.